Hey dear savvy investors, today we are diving into something that's got the whole world buzzing, the US Fed rate cut. If you're wondering what all the fuss is about, sit tight because we are breaking it down in simple terms. Let's start with the basics. What exactly is a Fed rate cut? Well, think of it like this. The Federal Reserves, which is basically the governing body of US financial system, has a magic lever called the federal funds rate. This is the interest rate at which banks lend money to each other overnight. Now you might ask, why do the banks need to lend money to each other at the first place? Well, banks need to maintain a certain cash reserve as per policy. To maintain that, they might have to borrow or lend money to other financial institutions. When the Fed decides to pull this lever down, bam, it's called a rate cut. Essentially, this means the cost of borrowing money goes down, not just for banks, but for you, me, and businesses too. Now, why is this rate cut such a hot topic? Well, this is happening for the first time since March 2020. And back then, we all know what was happening. The world was pretty much on fire with the pandemic. Since then, the Fed has been holding off on rate cuts to avoid stoking inflation or overheating the economy. But now, with economic growth slowing down, this rate cut could be the jumpstart everyone's been waiting for. It's like we've been driving on fumes and now the Fed is finally refilling the tank. Alright, so how much are we expecting the rate cut to be? Well, most experts are predicting anywhere between 25 to 50 basis points, which is just a fancy way of saying 0.25 to 0.5 percentage. It might sound small, but trust me, in the world of finance, it's like adjusting your speed just enough to avoid a speed bump. Not a huge change, but it keeps the ride smooth. Not just that, in the coming months, Fed is expected to cut rates gradually. So let's get to the part you've been waiting for. How does this affect the stock market? Well, a Fed rate cut means borrowings getting cheaper, which means businesses can take out loans at lower interest rates to expand their operations. As businesses grow, investors see more opportunities for profit, so stock prices tend to rise. Plus, when savings account and fixed income investments yield lower returns, people shift their money into the stock market, hoping for higher gains. It's like choosing between keeping your money in a piggy bank that gives you peanuts or investing it where it can grow. Hence, retired people living off interest rates given by banks are likely to suffer. Now let's talk sectors. Who is the real winner here? Housing finance companies and financial institutions are likely to be the first in line. With lower rates, more people are expected to take out loans, especially for homes. So those companies financing these big purchases are going to be grinning year to year. Now many people ask, how interest rates benefit the bank? Imagine you're a chip seller. You used to sell chips for 50 and 100 people bought them. Now you drop the prices to 40 and 150 people want to buy. You are making money even more. That's how banks and financial institutions can benefit even if the rates go down. But hold your horses. It's not all sunshine and rainbows. There is a flip side to this shiny coin. One risk of a rate cut is inflation. With more people borrowing and spending, there is a chance that prices could rise, leading to inflation. If businesses and consumers go on a spending spree, it could lead to higher demand for goods and services, which pushes prices up. That's inflation. And when inflation spikes, the Fed might have to pump the brakes and hike the rates again. So it's a delicate dance between boosting the economy and keeping inflation in check. So there you have it, the Fed rate cut in a nutshell. From what it is to why it's happening and how it's likely to shake up the stock market. If you are investing, keep an eye on those sectors we talked about. And always remember to diversify your portfolio. Because no one likes putting all their eggs in one basket, right? Before we jump into what's expected next in the stock market, you know the drill. like, share, subscribe, and hit that bell icon so you don't miss out on our next market updates. Thanks for watching, and until next time, stay informed, stay invested.